Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. Data dependent equals volatility. There's no question that Fed policy remains the primary force driving the money in bond markets for the third year in a row. Now, there was some speculation heading into this year that if Powell and company embarked on a widely anticipated rate-cutting spree, that perhaps the Treasury arena could take a collective breath and just let the policymakers do their thing. However, as we've discovered through the nearly first 5 months of this year, the best laid plans have not been realized. Instead, they've been replaced by a Fed policy that has a heightened data dependency to it. And according to my math, data dependence equals volatility in the bond market. But you don't need to take my word for it. Let's just look at how the Treasury 10-year yield has performed over the last month or so. You know, the overarching trend has been for higher yields in 2024, and recent price action underscores how changing Fed policy perceptions has created a noticeably elevated volatility quotient for the 10-year. You know, since the beginning of April, the yield has completed a round trip now by mid-May. And to give you some perspective, investors have witnessed a Treasury 10-year rate go from 435 in early April, rise up to 470, only to fall back to its starting point of 435. So think about it. The yield went on a formidable 70 basis point journey in just over a month's time. So why, you may ask? Well, the economic data, right? I mean, while Powell downplaying rate hikes at the May FOMC presser certainly helped, it's been recent economic data that's paved the way. Because the Fed has emphasized the importance of being data dependent in the monetary policy decision-making process, the Treasury market has been hanging on each key piece of new information and will continue to do so in the months ahead. And the policymakers are singling out inflation in the labor markets, and these two reports naturally have received the lion's share of attention, and rightfully so. So let's go back, right? A hotter than expected CPI report in April, combined with a robust jobs number, helped to push the 10-year Treasury yield to its highest level since early November of last year. And that's now been followed in May with an employment report that came in below expectations, a soft showing for retail sales, let's add that to the mix, and perhaps most importantly, a CPI reading that was not hotter than expected. So needless to say, this latest stretch of data played into the Treasury market's newfound narrative that rate cuts are back on the table, and it pushed that 10-year yield back down to the starting point level that I mentioned earlier. So let's wrap this up. Although 1 month's worth of data may provide for a short-lived positive reaction for bonds, the Fed's going to look at it differently. Given what's transpired on the inflation front up until this month's report, Powell and company don't appear to be in any hurry to begin implementing rate cuts anytime soon. So it's against this backdrop, even though rate cuts remain the odds-on favorite for later this year, investors should heed the tenor of recent Fed speak, and that reinforced the notion of rates being higher for longer. So I'm going to cut it there. I hope everybody has a great rest of the week, and be well.